Hello and welcome to National 5 Business Management. This is Lesson 4, Types of Ownership in the Private Sector. So today's learning intentions are we're learning to understand the sectors of economy and we're going to learn about the private sector. Success criteria will be to describe the three sectors of economy. You'll also be able to describe the features of the private sector with examples, and you can discuss private sector types of organisations. So we looked at sectors of industry, which were primary, secondary and tertiary. The sectors of economy means what types of businesses and who owns them. So the private sector, public sector and third sector. Private sector, which is the focus of this video, is owned by private individuals. Public sector is owned by the government, and the third sector is the voluntary and charity and non-for-profit organisations, including social enterprises. So in the private sector, you can see here the businesses are all driven by profit, and that profit only benefits owners and investors, financed by private money from shareholders and bank loans. So ownership, control and finance are three things that for Nat 5 you have to be aware of. So they're owned by private individuals, they're controlled usually by the owners, or they may have a managing director to run it for them, just depends, and the finance usually comes from their own money or equity as we call it, or sometimes money from banks or other investors. Okay, some examples we're going to look at: sole traders, partnerships and private limited companies. So here's a little Venn diagram just to introduce the concept of sole traders and partnerships. So we can see in the middle, the overlaps sole traders and partnerships is the disadvantage of unlimited liability, which I'll explain in a wee moment. But on the left hand side for sole traders, you can see that they make their own decisions. They sometimes have to work long hours, but they do get to keep all the profits. Whereas partnerships, they can actually share expertise, share responsibility, but they do have to share the profits. And again, we'll go over this in more detail in a moment. Here's some examples of a sole trader: joiners, plumbers, butchers, bakers, hairdressers, newsagents. It's important to remember that they may have staff working for them. They could work on their own. It could be a joiner or plumber who comes to your house and fixes things. That could be a sole trader. Or it could be that a newsagent might have one person who owns a newsagent shop, but they might have 3 or 4 staff who work for them. Examples of partnerships: lawyers, doctors, dentists, estate agents. There's quite a lot. That's why you see, it might say something like Slater, Hogg and Howison. You'll see the names in the title of the partnership. So we'll have to explain what unlimited liability is. So Sophie starts a cupcake business with £1,000. Good for Sophie. There we go. So the first 2 years sales go well, she makes a good living and she buys a Mini Cooper. Good for her. Well done, Sophie. However, things start to go bad, or rent starts to creep up, other costs go up, suppliers start to, they put prices up, and also demand falls because we're becoming more healthy eating, so sales fall, nobody wants cupcakes so much. So Sophie goes out for a while and trades for a couple of years, whatever, and she starts losing money, and she eventually owes the bank, or she's got a shortfall of 12 grand. So what happens next? Unlimited liability really means our car will go, potentially, because Sophie is liable for all the debt. It's unlimited, so it can include personal assets, could be your car, your house, whatever. Both sole traders and partnerships have unlimited liability. So a sole trader, let's go through the advantages. They get to keep all the profits. They keep information on the business private, so the competitors can't find out. Very easy to set up. There's hardly any legal requirements. Disadvantages: unlimited liability. You're liable for all the debt. You've got no one to share the workload with. You may have people working with you, but you may not have to. You have to make all the decisions yourself, and it can be hard to raise finance from the bank. The bank might not agree to. You might need a few grand or whatever, but the bank might not believe that the business is viable enough to get that money back. Again, some examples, the same ones before: joiners, plumbers, butchers, bakers, hairdressers, newsagents. There's loads. Partnerships, advantages: You can share the workload because you get other partners who might bring expertise and new ideas and skills. The risk is spread because you've got more than one person's money in. Responsibilities are shared among partners. You can raise more finance than sole traders. Disadvantages: you've got to share those profits, so the better you do, the more you make money. You will split it between 2 to 20 partners. The minimum number of people in a partnership is 2 and the maximum is 20 allowed by the law. You can fall out or disagree. You might not see the same way the company's going. You might disagree on what to buy or what customers to target. Unlimited liability is still a major disadvantage. And again, those examples: lawyers, doctors, dentists, and estate agents. And again, there's more than that. Private limited companies, here's an example here of Arnold Clark. They're owned by shareholders, at least 2, have limited liability, which is the opposite of unlimited liability. So for example, if Arnold Clark starts a business with, say, £5,000 and the business owes £1,000,000, Arnold Clark only loses his £5,000 stake. The same with if you're shareholders eventually and you buy in to the business and you spend money on it, whatever your stake is, whether it be £100, £5,000, £500,000, if the company owes millions, you only lose your initial stake. It's registered with Company House, and you can usually raise far more finance than sole traders or partnerships. What we call the shareholders' cut of the profits, the payout you get every year, is called a dividend. Sometimes they don't get a dividend if they don't make enough profit, or if they don't make profits. But for that 5, just think about the slice of the pie, the profits that shareholders get are dividends. And remember, shareholders are part owners in the business. So some advantages: limited liability, you can raise more finance from shareholders and of course from banks. Disadvantages: you've got to split the shares, which could be literally, you could have 100 shareholders or 1,000 shareholders, just depends. But you have to disperse those profits, those dividends out amongst those shareholders. And there are some extra legal requirements you have to set up, registering with Companies House and other legal information that does take time and cost money. So, little planning for you if you're watching this. Here's something I've quite enjoyed doing with classes. You can draw a wee picture of your own brain and then create your brain, fill it up with what you've learned today. So success criteria: hopefully you can describe the 3 sectors of economy very briefly: private, public and third. You can give the features and describe the features of private sector with examples: sole traders, partnerships and private limited companies, also sometimes called LTDs. And you can discuss, which means advantages and disadvantages of the private sector types of organisations. So again, just to connect, website www.mrmcgowan.blogspot.com, Twitter @MrMarcusMcGowan, and for educators, if they want to look at my resources, there's my Teachers Pay Teachers site. So remember, keep calm and love business, and I'll see you in the next video.